December 16th, 2025. Silver hits $66 per ounce. All-time record. Not inflation adjusted. Actual nominal high. Higher than 1980, higher than 2011, higher than any price in 5,000 years of recorded silver history. And Wall Street is nervous, not the retail crowd. They're euphoric. Online forums explode with $100 silver predictions, $200 targets, even $400 forecasts. Everyone's an expert. Everyone knows someone who's getting rich. The momentum is intoxicating. Silver's up 114% year to date. That's not a rally, that's a moonshot. But the professionals, the ones who've seen this movie before, they're issuing balanced warnings. Citigroup's Max Layton sees silver hitting $62 base case, $70 bull case for 2026. Cut short-term forecast from $55 to $42 warning of correction risk. HSBC analysts raised 2025 average to $38.6, but flagged volatility despite euphoria. And BNP Paribas remains structurally bullish long-term while cautioning profit-taking pressure and potential 30 to 40% drawdowns before higher targets. Violent drawdowns. That's banker speak for this thing could crash hard and fast. Now, here's the uncomfortable question nobody wants to ask when prices are screaming higher. Are we in a bubble? Is silver at $66 the rational response to supply deficits and industrial demand? Or is this euphoria, greed, the intoxicating belief that prices only go up, that this time is different, that the fundamentals justify any price? Because if you study market history, if you understand how bubbles form and burst, if you recognize the psychological patterns that repeat every single cycle, what's happening right now in the silver market looks disturbingly familiar. Let me show you the exact warning signs that Wall Street analysts are flagging how this setup compares to 1980 and 2011. The specific mechanics of how euphoria turns to panic, why even bulls are warning about drawdowns, and what the sentiment indicators are screaming right now. Because understanding whether you're in a sustainable bull market or a speculative bubble, that's not academic. That's the difference between wealth preservation and wealth destruction. The first warning sign is velocity. Not just that prices are rising, but how fast they're rising. Silver started 2025 around $29 per ounce. By December, 66. That's a 114% gain in 12 months. And most of that gain compressed into the final quarter. From September to December, silver surged 40%. That's a parabolic move. Prices don't rise in straight lines during sustainable bull markets. They grind higher, pull back, consolidate, grind higher again. Parabolic moves, vertical price action, that's late-stage bull market behavior. Or bubble behavior. Here's the pattern. Sustainable bull markets take years to develop. The gold bull market from 2001 to 2011 took a decade. It had corrections, 20% pullbacks, consolidation phases. But the trend was relentless upward over 10 years. Silver's current move compressed everything into 9 months. The time compression matters because it doesn't allow weak hands to be shaken out, doesn't allow excesses to be purged, doesn't allow the market to build a foundation. And wait, you might be thinking, but the fundamentals are strong. Supply deficits, industrial demand, all the things everyone talks about. True, but here's what bubbles teach us. Fundamentals can be correct, and the price can still be wrong. In 1999, the internet was going to change the world. The fundamental was correct, but pets. Calm at $300 million market cap was still insane. The fundamental trend was real. The price was fiction. Silver's supply deficit is real. Industrial demand is real. But does that justify $66 or $100 or $200? At what price does the fundamental story become overwhelmed by speculative excess? That's the question Wall Street is asking. And their answer, based on historical volatility patterns, is uncomfortable. Felipe Geisels, Chief Strategy Officer at BNP Paribas Fortis, while bullish on silver reaching $100 eventually, specifically warned that profit-taking could spark some violent drawdowns before the metal hits $100 an ounce. Violent drawdowns, not corrections. Drawdowns. That language is deliberate. A correction is 10%, maybe 15%. A drawdown is 30%, 40%, maybe more. And when analysts use the word violent, they mean it happens fast, not weeks, days. So why would a bull like Geisels, someone targeting $100, warn about violence on the way up? Because he studied 1980 and 2011. And he knows what happens when speculation overwhelms fundamentals. Let me show you those comparisons because the parallels are eerie. January 21st, 1980. Silver hits $50.35 per ounce. The Hunt brothers, Nelson and William, had spent years accumulating physical silver and futures contracts, controlling an estimated 100 million ounces of physical metal and contracts representing another 150 million ounces. That was roughly 1/3 of the world's deliverable supply. They were betting on inflation, dollar collapse, and their own ability to corner the market. The psychology in early 1980 was identical to today. Silver was going to $100, maybe $200. The dollar was finished. Anyone not in silver was a fool. Magazine covers, newspaper headlines, dinner party conversations. Everyone talked about silver. Then comics changed the rules. January 7th, 1980, Silver Rule 7 restricted futures positions and increased margin requirements. The Hunt brothers, who'd borrowed heavily to finance their positions, couldn't meet margin calls. March 27th, 1980, Silver Thursday. Silver crashed from $21.62 to $10.80 in a single day, a 50% collapse in hours. From the peak of $50 in January to the low of $10.80 in March, silver fell 78% in 9 weeks. Now look at the sentiment. Before the crash, everyone was bullish. After the crash, everyone was destroyed. The transition from euphoria to panic took days, not months. Fast forward to 2011. Silver started the year around $30, surged to $49.82 by April 25th, then crashed to $26 by September, a 50% decline in 5 months. The pattern repeated. Parabolic rise, euphoric sentiment, then sudden collapse. What caused the 2011 crash? Margin requirement increases, just like 1980. When CME Group raised margins 5 times in 9 days, leveraged longs couldn't hold positions. Forced liquidation, cascade selling, panic. Both times, 1980 and 2011, silver approached the $50 level and failed. Both times, the rally was driven by legitimate fundamentals, inflation concerns, supply worries, plus massive speculation. Both times, the market believed prices could only go higher. Both times, the market was wrong. And here's what's terrifying. Silver in December 2025 already broke through $50, the level that killed rallies twice before. It hit $66. That should be bullish, right? Breaking resistance, new highs, clear path to $100. Maybe. Or maybe it's the blow off top, the final surge before the collapse. Because sentiment is now more extreme than it was in 1980 or 2011. Let me show you the sentiment data, because this is where the bubble warning gets loud. Fear and greed indices measure market sentiment on a scale from 0 to 100. Below 40 is fear. Above 60 is greed. Above 75 is extreme greed, the danger zone where markets are overbought and vulnerable to reversals. Gold sentiment indicators have been hovering between 60 and 75 during 2025, elevated but not extreme. Silver sentiment, however, appears even more stretched based on retail activity, social media discussions, and physical premiums. When everyone is bullish, when retail investors are pouring in, when premiums over spot are $8 to $10, when mints can't keep up with demand, when delivery times extend to 12 weeks. That's not healthy market function. That's late-stage mania. And here's the key insight from behavioral finance. Markets top when sentiment reaches maximum bullishness, not when fundamentals weaken. Fundamentals can remain strong while prices collapse because price is set by the marginal buyer. When the last buyer buys, when everyone who wants silver already owns it, who's left to push prices higher? Nobody. That's when selling begins, not because fundamentals changed, because there are no buyers left. This is the greater fool theory. You buy silver at $60 hoping to sell to someone at 70. They buy at 70 hoping to sell at 80. Eventually you run out of fools. The music stops, and whoever's holding the asset, when sentiment flips, gets destroyed. Now, I'm not saying we're at that point. I'm saying the warning signs are flashing. Let me show you the specific mechanics of how bubbles burst, because understanding the process is critical. Stage 1 is disbelief. Prices rise, but most people ignore it. Silver from $20 to $30 in early 2024. The crowd dismissed it. Industrial demand, supply deficit, nothing special. Stage 2 is awareness. Prices accelerate. Media coverage increases. Silver from $30 to $40. Suddenly, articles appear. Analysts raise targets. Retail interest grows. Stage 3 is enthusiasm. Prices surge. Everyone talks about it. Silver from $40 to $50, breaking the old resistance. Forums explode. Social media is wall-to-wall silver content. Dealers can't keep inventory. This is the phase where fundamentals are still strong, but speculation starts overwhelming them. Stage 4 is euphoria. This is where we are now. Silver at $66. Everyone's bullish. Predictions get extreme. $100, $200, $500. Nobody wants to hear warnings. Skeptics are dismissed as bitter or stupid. The narrative becomes religious. Silver to the moon. Stage 5 is the top. Prices plateau. New buyers hesitate. Sentiment is still bullish, but momentum stalls. This can last days or weeks. It's imperceptible in real time. You only see it in hindsight. Stage 6 is anxiety. Prices dip. Bulls buy the dip. This is the last chance before $100. But prices don't recover. Dips get deeper. Anxiety creeps in. Stage 7 is panic. Prices collapse. Margin calls force liquidation. Buyers disappear. Sellers overwhelm the market. Silver falls 30% in a week, 50% in a month. Forums go silent or turn vicious. Retail investors who bought at the top are destroyed. Stage 8 is capitulation. Prices bottom. Sentiment is maximally bearish. Nobody wants silver. This is when smart money accumulates. But retail, burned and broke, swears never to touch silver again. This cycle repeats. Every bubble, every market. The only question is where we are in the cycle right now. The bulls will tell you we're in stage 3, early enthusiasm, with much higher to go. The bears will tell you we're in stage 4, late euphoria, with collapse imminent. The honest answer is nobody knows for certain until after the fact. But here's what we can observe. Velocity is extreme. Sentiment is elevated. Wall Street analysts, even the bulls, are warning about drawdowns. Retail is euphoric. Physical premiums are at levels that historically mark tops. Lease rates spiked above 11%, indicating stress. Delivery times are extended. These are late cycle indicators. And the most concerning signal, mainstream adoption. When silver makes CNBC headlines, when your relatives ask about buying silver, when everyone knows someone getting rich, that's the top tick. Markets top on maximum participation. They bottom on maximum fear. Now let's talk about what triggers the reversal, because bubbles don't pop randomly. There's always a catalyst. In 1980, it was regulatory intervention. COMEX changed margin rules. The Hunt brothers couldn't sustain their positions. Forced selling triggered cascade liquidation. In 2011, it was also margin changes. CME raised requirements 5 times in 9 days. Leveraged longs got crushed. Panic selling followed. In 2025, what could trigger the reversal? Several candidates. First, another round of margin increases. COMEX already tightened some requirements in October. If they tighten further, forcing leveraged speculators to liquidate, it starts the cascade. Second, a stronger dollar. Silver is priced in dollars. When the dollar strengthens, silver falls. If the Fed pauses rate cuts or signals less easing than expected, the dollar rallies, silver collapses. Third, profit-taking by large holders. If institutions who bought at $30, $40, $50 decide to lock in gains, their selling creates supply. When supply overwhelms demand, prices fall. Once prices start falling, momentum traders flip from long to short. Algorithmic trading amplifies the move. Stops get hit. Cascade accelerates. Fourth, a black swan event. Geopolitical resolution, sudden economic strength, anything that reduces safe haven demand. Silver surged partly on fear. If fear subsides, silver falls. Any of these triggers the same outcome. Prices fall, sentiment shifts, euphoria becomes anxiety, anxiety becomes panic, and the correction that analysts warned about becomes reality. Citi's short-term cut from $55 to $42 suggests 30 to 35% correction risk from current levels. That's not a minor dip, that's substantial downside. And Citi's Max Layton just called silver $62 base case for 2026. They're not perma-bears. They're a major bank with institutional clients. When they flag short-term risk amid long-term bullishness, their models show excessive near-term euphoria. Analysts like HSBC flag volatility risks, noting 2025 forecasts around $38 to $45 amid parabolic moves. Current prices at $66 represent 40 to 70% premium over those targets. That's bubble territory being priced in. And here's what should concern anyone holding silver right now. When analysts who are structurally bullish on silver, who benefit from higher prices through trading and client activity, are warning about corrections, you should listen. They're not trying to scare you. They're trying to prepare you because they've seen 1980, they've seen 2011, and they recognize the pattern. So what do you do with this information? That's not for me to say directly because I'm not providing financial advice. I'm analyzing patterns. But let me show you what history teaches. In 1980, investors who sold near the top preserved wealth. Those who held through the crash lost 78% in weeks. Some never recovered. In 2011, investors who took profits above $45 protected gains. Those who held, believing $100 was coming, watched 50% of their wealth evaporate in 5 months. In 2025, we don't know yet. Maybe silver goes to $100, $200, and the bulls are vindicated. Maybe it crashes to $40 and the bears were right. Or maybe it consolidates, ranges between $50 and $70 for years, frustrating both sides. But here's what's certain, volatility is coming. Whether it's upward volatility toward $100 or downward volatility toward $40, the next 6 to 12 months will be violent. BNP analysts specifically use that word, violent drawdowns. If you own physical silver, stored outside the banking system with no leverage, bought as long-term wealth preservation, you can afford to ride through volatility. Physical holders aren't forced to sell. They can wait years, decades if necessary. But if you're leveraged, if you bought silver on margin, if you're in futures contracts or leveraged ETFs, if you need to sell to meet obligations, you're vulnerable. When the drawdown comes, and it will come, it won't give you time to react. It'll be fast, violent, and merciless. History teaches this lesson every cycle. Leverage amplifies gains on the way up, but it amplifies losses on the way down. And in parabolic markets, the down is faster than the up, much faster. The professionals know this. That's why they're warning, not because they're bearish on silver long term. Most remain bullish on fundamentals, but they're cautious on price right now at $66 after a 114% gain in 12 months, with sentiment at euphoric levels. Caution isn't bearishness. Caution is survival. And survival matters more than catching the last 20% of a move that might precede a 50% crash. Let me end with this. Market tops are a process, not an event. They take time to form. Distribution happens quietly. Smart money sells to euphoric retail. This process can take weeks or months. You don't ring a bell at the top. You only know it was the top in hindsight. But warning signs exist. Extreme velocity, elevated sentiment, analyst warnings, extended retail participation, physical premiums, all flashing right now. Does this guarantee a crash? No. Markets can remain irrational longer than you can stay solvent, as the saying goes. Silver could push to $80, $100, even higher before correcting. Bubbles often reach levels that seem impossible until they're reached. But the risk-reward has shifted. At $30, the risk was minimal. At $66.6, the risk is substantial. You're not getting paid adequately for the downside you're taking on. And that's what Wall Street is saying. Not that silver can't go higher, that the probability of a violent drawdown has increased significantly, and when the drawdown comes, it won't give you time to adjust. So watch the signals, watch sentiment, watch lease rates, watch margin requirements, watch analyst language, and most importantly, watch your own emotions. If you find yourself checking prices every hour, if you're euphoric when silver rises and anxious when it dips, if you're telling everyone about silver, if you're thinking about leveraging to buy more, those are your personal warning signs. Euphoria clouds judgment, and clouded judgment in late-stage bull markets destroys wealth. The warning from Wall Street isn't that silver is going to zero, it's that we're in the danger zone, the phase where fortunes are made and lost, where the difference between getting out near the top and holding through the crash determines financial outcomes for years. Position accordingly, whatever that means for your situation. Just recognize that the warning is real, the pattern is clear, and history has a way of rhyming. If this analysis helped you understand the risk profile of the current silver market, you need to watch my next video breaking down how the COMEX paper market actually functions and why that mechanism might be creating the very bubble conditions we're discussing. The title is Inside the COMEX: How Paper Silver Controls Real Prices, and it explains the leverage, the fractional reserve structure, and why the paper market could be the trigger for either a massive squeeze or a catastrophic collapse. Link in the description. Don't miss it, because understanding COMEX is understanding the game board where this entire battle plays out. The euphoria is real. The warnings are real. And the next 12 months will determine whether we are witnessing a sustainable bull market or the third great silver bubble about to burst.